Welcome back to Be Great Economics. This is Nate. So I wanted to talk about market capitalization and how technically it's irrelevant. Now, don't get me wrong. It is very valuable if you are evaluating the value of a company, the pricing of a company. Corporations or securities that are sold by corporations, actually the company produces something and you're valuing the production rate, right? Whether it's through the dividend that they produce on the share. Let's say it's a dividend stock and you're not expecting it to grow, you're expecting it to continue to pay out a dividend on a percentage of it. So the market capitalization matters because how much am I going to pay for how long does it take to make back my price? If it's for a growth stock, you're looking at what's the total revenue being produced and what's the projected growth. And so that one tends to get overvalued pretty quickly because you're trying to bid up the price. That's kind of the point to growth. But when it comes to monetary assets, it's kind of irrelevant. I see a lot of talk about things like Bitcoin's going to flip gold, or silver's going to go to whatever X trillions of dollars market cap. It's all kind of irrelevant, mostly because all that matters is what is the current available liquid supply being traded for, because there's liquid and illiquid supply. Take Bitcoin, for example. There are 21 million coins that will ever be produced, right? The problem becomes there are 18.5 million that have been produced so far, but approximately like 1 to 2 million are completely lost forever. So if 14.5 million are illiquid supply right now, meaning that they usually, once they go into these wallets or into this collector's collection, these holdings, then they don't come back out onto the market almost ever. So if illiquid supply is a factor, then all that really matters is what can we trade the liquid supply for? How much is actually available for trade? Now, everything has a price, and that's kind of the logic to using a market cap. If gold goes up 100% to $3,600, there will be a lot of sellers of gold, because if it does that over a short period of time, right, because there's also a time variable here of what's the expectation of growth. If we're exceeding the expectation of growth, more people will be inclined to sell their gold. There will be more buyers because the volume had to happen to cause that, but there will be more sellers that come out of the market that wouldn't have sold if it only went to 2,000. The reason for this is primarily expectations versus actual activity. And so I'm going to kind of show how a liquid and illiquid supply work. And I have these 50 mercury dimes. These are 90% silver coins. These are from before we had the Roosevelt dime. I'll try to give you a close-up if I can. These trade for around like $2. Well, actually, these are a little more, but basically these 50 coins would be $100 in total cost basis, or 110. I think they trade for more right now because there's some premium on these. But ultimately, it comes down to it. These are coins we're going to use at a 10 cent face value, right? So the market capitalization of all of these 50 coins would be $5, right? Pretty simple concept to grasp. 10 cents per coin, $5. That's it for 50 coins. So it's just a multiple. Now, here's the thing. If these coins are hard to get, a bidding will happen to cause them to go up, and the market cap, if these are all the coins that are available in the entire world, the market capitalization of these 50 mercury dimes will go up because people will bid on them. Now, here's the thing. If all 50 of them are available and there's only X amount of buyers, then it won't get bid up very much, or it will fall because the total number of people interested will fall away. So let's say there's 3 people, you, me, and this third person here, this little candle, right? We've got these 3 people here and these 50 dimes. Now, all but say 5 are illiquid. I have about half of the remaining supply, these 20, and then the candle has the other approximate 20, right? So that's 6, there we go, 5. There are 5 mercury dimes total in this market cap. What's gonna happen here is that you are a holder of none, and you wanna be holder of some or many. So what you're gonna do is you're gonna start buying them. Now, I am still collecting them, and Candle is not, okay? So I buy one. Now there's only 3 left. The market capitalization hasn't necessarily gone up, but now there's a bidding problem here because you still want more and I still want more. Now I'm less inclined to bid up the price too much because my cost basis is pretty low versus you still don't have the number that you want. So you're going to bid up the price even more. You're willing to put in a higher bid. So these start getting bid up. My supply increases in value as you bid them up. So what I'm going to do is I'm going to sell some, and now the market cap is increased even further. And the market cap increasing also implies that Candle adds some to the market. So now there's 5 again. So we should be at the same price, but we aren't because we've all agreed that they're a little more valued. The price starts to fall again, and you buy more, and I buy one back at a lower price, at a lower cost basis. Candle hasn't bothered to do anything because all they did is sell one and just sit there. They're a very illiquid supply. What I'm getting at is that if I put all of this suddenly into the market cap might be high, but the volume of trading to sell pressure versus how much you can buy at the current price, the bidding is going to drop drastically because you're going to keep buying as the price goes down because the selling has increased. And until you end up with enough of them that I go, I should buy in low too, and I start doing it, and then Candle says it's low and he'll buy some, all of a sudden we're back to a relatively illiquid supply. Now, when we talk about illiquid supply, let's say these 5 coins aren't available at all. These are being produced. These are in a mine somewhere. Now, I have 5 coins. There's 5 coins here. You have your 15, and Candle still has almost 20. If these are available later, but they're not available now, and there's a cost incentive to produce them, the more the price goes up, the more incentive there is to pull these out. But ultimately, there are only 5 of these available. We might inspire more hasty production. We might inspire more, making this illiquid supply more liquid in that, say, I'm the miner over here, produces them, but then holds them because the price is too low. But then when the price starts rising, they're playing a game here of trying to maximize their efficiency and price. Ultimately, when it comes down to it, if what we saw with a lot of cryptocurrencies, you would see 90% of the coins were completely illiquid, and all that was available for trading was the initial offering that people could apply for or purchase for X amount. And so Candle, I, and you became initial holders, and there's not very many left for anybody else to bid on, but the 90% is still here. What does that do for the market capitalization? It brings it way up, because most of the supply is completely illiquid. And if this will not come onto the market, or only come onto the market if a VC or a producer or something like that sells, and let's say it is a really illiquid supply because there's a lockup or something like that, then you're going to see market caps in the billions of dollars for cryptocurrencies where there's a high demand, a low available supply that causes high volume trading for the total market cap, which raises the market cap of these, but these are all irrelevant. When it comes to something like Bitcoin, same thing. Now, what I'm getting at is, and what the entire point of this conversation is, that it doesn't technically matter what one coin flips another. It's a milestone, like completing a portion to a marathon. You're like, oh yeah, I did X. Well, you still have all of this in front of you, and it doesn't really matter because if this is illiquid, what is the price that this becomes liquid? What is the point? If this can't become liquid, then that doesn't matter. This is all technically irrelevant. But if it, like, say, lost coins, right, or silver that is in outer space, this is so illiquid that the reality is you're not going to start mining this in outer space. The same problem applies to most of these, and it bothers me when people try to play the market cap game. Bitcoin's going to flip gold. Like, look, I'm a big fan of Bitcoin. It doesn't matter. It really doesn't matter. All that matters is, in terms of investing value, is this price going to be bid up because of total supply and demand dynamics? And what does it offer you in terms of actual use case and function? For Bitcoin, it's just self-sovereign money. That is it. There's no real utility. You can build onto it. We can now produce smart contracts thanks to upgraded programming in it. But ultimately, when it comes down to it, it's just a form of money. It is just exchange currency. And so outbidding the price of gold has like 10, I really think it's closer to 10% once you account that jewelry is wearing money on you, right? If I make a necklace out of this, it's more about, I'm wearing money, right? Gold jewelry is more about wearing money on you. I'm really more convinced that 10% of gold's market cap is actual industrial use, and the rest of it is just technically money if you count jewelry as a form of wearing extravagance of money. When it comes to something like that, you're ultimately more concerned how illiquid is the total supply. People who hold gold of the $10 trillion market cap value holding the gold so much that it is a much more illiquid supply. Nations like Canada can sell off their gold. And that, quite frankly, is a bad choice. I don't care what your view of the futures are. You should probably have some form of insurance or security. Most nations, realistically, they hold their value through the productivity of their people. So yes, the nation doesn't technically need gold, but at the same time, why would you take that risk when you have a reserve asset that can counter or arbitrage the insecurity of other currencies? But ultimately, it comes down to it. Market capitalization is technically irrelevant for anything other than securities, because it all has to do with currently traded liquid supply and the current bid price of the available supply or the available individual currencies. So I hope that helps make sense. When you see people extrapolate where a market cap is going, it's kind of irrelevant. It has to do with bidding total liquid supply. And so that's one reason why I like Bitcoin, is that you can see on-chain metrics of exactly how much is out there, exactly how much has moved recently, how many people are capitulating in terms of short-term holders, long-term holders, what we can see for whales or total, with gold. The constant problem with gold is we don't know how much is being held somewhere. That doesn't mean that the price and market cap aren't functionally real, and if anything, can be suppressed because of the same problem. It can also be overstated. But with something like Bitcoin, the price is entirely based on that leverage. So overall, thanks for watching. I think that helps clear up some of the dumb arguments I see for market capitalization. It's not that the milestones don't matter. It's that they don't really play a role in total value of what's available in liquid supply. So have a great day. Thanks for watching. I hope that makes sense.